Hello, I'm Sarah Allen and welcome to Fund in Focus. Today, Tamara Haban-Beer Stats from BlackRock is going to take us through factor investing. Tamara, welcome.
Thanks, Sarah. It's a pleasure to be here.
So to begin with, what is factor investing?
For us, factor investing is really around seeking to identify particular characteristics within a universe of securities that exhibit certain qualities. So for example, quality is one of those characteristics. Value is another type of characteristic. Momentum is another one. And there are others, but we're focusing on these three in particular. And I guess the important thing to note is this style of investing has been around for decades, forever in fact. So it's historically been the domain of active managers, and they've actually charged a premium for that. And I think a helpful analogy that we often look to when thinking about what is factor investing is think of what travel used to be like 20 years ago. So not that long ago, only 2 decades ago, but you would have had to go to a travel agent who had proprietary information on specific hotels, really trying to identify exactly what you wanted, whether it fit in with your needs. Now, we can actually think of factor investing in a similar way because we've got the internet now. So that information that's now available to us, where you can choose everything online from hotel star rating to proximity to the beach or proximity to the city, reviews. There are all sorts of characteristics that you can filter and make your own choice on. And that's actually quite similar to factor investing. It's really around identifying characteristics that filter out a specific group of stocks.
So you've mentioned 3 factors there. Can you provide some more detail on those and why BlackRock selected those particular factors?
So for quality, for example, this is as the name suggests, it is a factor exposure that gives you exposure to companies that have stronger balance sheets. So we look at their profitability metrics, their leverage ratios, as well as their earnings stability. So it's a multiple metric approach to try and identify those companies that are more robust. Value is another factor that we're looking at. This is really around trying to identify companies that are undervalued relative to their peer group. Again, taking on a multiple metric approach, we look at ratios such as price to book, price to earnings, as well as enterprise value to cash flows. And then the third one that we spoke about was momentum. So momentum is really about trying to identify those stocks that are currently experiencing strong price momentum. Again, as the name suggests, very helpfully, really about trying to capture those stocks that are on an upswing. And we look at price movements over a 6 and a 12-month period.
What's the case for incorporating factor investing in a broader portfolio?
Look, it's actually something that we've found that active managers have been seeking to do for decades, actually. And I think at its heart, it is trying to diversify portfolios, give portfolios resilience, and I guess identify those particular securities that are going to be drivers of long-term outperformance.
How is a factor view complementary to a sector view of portfolio management?
Well, like sectors, factors can be somewhat cyclical. So when we consider factor investing strategies, particularly in the context of an economic or a business cycle, sometimes one factor strategy can be more appropriate than another factor strategy if you're taking factors in a tactical type trading lens or a shorter time frame. So like sectors, which can also be cyclical, factors can have that effect of being, able to tilt your portfolio, I suppose, or direct your portfolio into a particular style of investing given the overall economic context.
How can factor investing reduce concentration risk in a portfolio?
Again, it's really based on data and identifying securities within a large universe. So sometimes when we look at an index such as the MSCI Australia Index, that has naturally a tilt to value stocks. So by looking at something like a quality factor, you can tilt into quality to kind of reduce the concentration risk that you might have in value stocks.
How can investors incorporate factor investing into their investments?
Well, there's a number of ways. So ETFs are one vehicle, one very kind of accessible and transparent and cost-effective vehicle, frankly, that's now available to investors. So that's one way of doing it. And I think the key differentiator between ETFs and perhaps what you might have seen from traditional mutual fund active managers is again their ease of access and certainly the lower cost as well.
What's one thing that investors should keep in mind when it comes to factor investing?
Well, not all factors are created equal, so I've given, I guess, a broad explanation of three of the factors: quality, value and momentum. But really it certainly pays to look under the hood. So what kind of rules and constraints are put around the identification of the securities that go into that fund, and it's certainly, in our view, all factors aren't created equal.
Thank you so much for sharing your insights on factor investing today, Tamara.
Sure, pleasure to be here. Thanks, Sarah.
If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.